Good afternoon and welcome to the BRAEMAR PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. And I would now like to hand you over to CEO James Gandhi. Good afternoon to you.
Good afternoon and thank you. Once again, thank you so much for joining us today. We really appreciate. Today, myself and Grant will talk you through the various slides and give you a full update on where we are in the first half of this year and about some of the shipping markets, etc. And basically talk to the strategic framework of the business we put in place last May, etc. So thank you once again. Here's Grant, please. I can't see it all. Okay. Right. First of all, I'd like to say it's definitely been a first half of some challenging markets, but at the same time, I think we can prove and show to you today that the resilience of the business and the diversification of where BRAEMAR is today, we've been able to come through that first half, and we're feeling very optimistic for the second half of the business going forward. On top of that, so it's unchanged for our HY26 numbers. A strong forward order book, we're still improving. As you can see later in the slides, we're strengthening from where we were at the end of September, end of August, and even further increase in September, against what we would call geopolitical upheavals in the first half, the tariffs, etc. But at the same time, the business has proved itself it's been very strong in that respect. That's basically proving the fact that we've added many strings to our bow, and the fact that our securities business has performed exceptionally well. And a number of key highs have been made within the business. We've obviously, you see that we've announced the fact that we've opened office in Africa in Cape Town. The UK OTF license is live now, with intention to get our EU OTF license application progressing very well. And of course, we're applied for DFIC in Dubai for our financial markets. Apart from that, we're still very clear on where our objectives were in May last year about where we are looking for opportunities to actively complement our present business. So thank you.
Thanks, James. Afternoon, everyone. I'll talk about the group's financial performance. So revenue at £63.9 million for the first half was 16% lower than the previous period, and that was really driven by weaker chartering performance, and particularly in tankers, where we saw weaker rates and longer voyage times. Given the geopolitical upheaval, we saw vessels taking longer voyage times, which also led to fewer fixtures because there were fewer vessels available. In US dollars, revenue was $73.8 million, which is 13% lower. So we also suffered a bit from the weaker US dollar in the period. Underlying operating profit before acquisition-related items was £5.6 million, 29% lower than the previous period, really driven by those lower revenues. Underlying operating profit margin at 9% was 1% lower than the same period last year. And again, that was really just driven by the lower revenues. We have strong operational leverage in the business, and as you grow the revenues, you expand your operating profit margin. And as that revenue came down a bit, we saw a small decrease in the operating profit margin. The forward order book, as James mentioned, continues to be strong. At the end of August, it was $73.8 million. And in September, we've seen that increase further to $81.2 million. And that gives us confidence for the full year outlook. We declared an interim dividend of 2.5p, and that reflects the capital allocation framework that we launched in May when we announced our HY25 full year results. At the period end, we had net debt of 5.6 million, and that really reflects the usual working capital cycle of the business. We also completed our share buyback in this period of just under £2 million. And of course, we saw a weaker performance in the first half, so we had slightly less cash coming in the first half, and pleasingly, at the end of October, that was net cash positive. So just looking at the income statement in a little more detail now, as I've said, revenue for the period was 16% lower at £63.9 million, 13% lower in dollar terms. Chartering was 25% lower. Investment advisory, which includes sale and purchase and corporate finance, was 6% lower. And risk advisory, which is our securities business, was 9% higher. Importantly, we call it risk advisory, but we do not take market risk. It's a broking only, agency broking business where we just collect commissions. Operating expenses were 14% lower, and that was really primarily driven by lower bonus costs on the back of a lower revenue performance. Underlying operating profit before acquisition related items, £5.6 million, as I've said, 29% lower, with that margin reducing slightly to 9%. Underlying earnings per share, 9.3 pence, and in line with our updated capital allocation framework, as I mentioned, the interim dividend is 2.5 pence. If we look at the breakdown of revenue in a little more detail, whilst overall revenues are down, you can really see the importance of having a more diversified revenue base and building resilience, and we've presented a very similar slide in previous periods. While total revenue was down 16%, chartering revenues were actually 25% lower, where we had those lower rates and longer voyage times impacting revenues. And the BRAEMAR tanker index, which is a measure of tanker rates, was actually down 29% versus the same period last year, whilst the BRAEMAR dry index was down 17% than where it was a year earlier. Our offshore desk continued to perform strongly. Investment advisory, as I said, sale and purchase and corporate finance, was £1 million lower. The S&P team, the sale and purchase team, were very busy in the first half, but it was impacted to some extent by the ongoing uncertainty in the markets. But they are very busy, and we expect to see a good performance from S&P in the second half. And corporate finance revenues, whilst not particularly large, we pleasingly saw a 49% improvement in those revenues as the team moved into different mandates. The lower revenues were partially offset by the risk advisory and securities revenues, which increased by £1.1 million. And that was a strong performance from our wet forward freight desk, our coal desk, and our natural gas desk, as the Organised Trading Facility, or OTF, went live in the UK, and that allowed our clients to trade more products with us. Moving on to operating costs, they continue to be well controlled. And we're continuing to really focus on balancing between driving efficiencies and investing for the future. Staff costs were £10.4 million lower, reflecting slightly lower headcount, but primarily lower bonus costs on the back of the reduced revenue. We had an increase of £0.5 million on one-off payments to leavers as we focus on efficiencies across the business. And office costs in the period were £0.6 million higher, as we had some space that was let. That tenant's moved out, and we're now reletting that space at the moment. So at the end of the period, looking at liquidity, the group had a net debt position of £5.6 million. And that really, as I said, reflects the typical working capital cycle of the group. We pay bonuses after the year end, and then we build up the cash as we go through the period. That £5.6 million includes £1.9 million of restricted cash, which will be used to settle the commission obligation that went back to the investigation from 2023. So looking at the movements, the opening net debt on the 1st of March, £2.5 million. Operating cash flows of £5.7 million. General working capital movements was a decrease of £1.7 million. We paid finance and tax of £1.3 million. We continue to buy shares for the employee share ownership plan of £1.5 million, and of course, then the share buyback of £1.8 million. We also had lease repayments of £1.4 million and various other cash flows of £1.1 million to give us that net debt position of 5.6. But as I said, at the end of October, the business returned to a net cash positive position. So just moving on to the key performance indicators, as I've said, revenue 16% weaker, really reflecting those lower chartering rates. Revenue per head improved slightly from the second half of last year to £166,000 or $214,000, which reflects a slightly lower headcount in the period. Operating profit margin at 9%, slightly lower, just reflecting that operational gearing in the business. The forward order book remains strong, 73.8, and it's increased further in September. I covered off the debt and the dividend at 2.5 pence. Now, just talking a little bit about the forward order book in a bit more detail. The forward order book is a measure of revenue to come in future periods, whether it be that we had vessels on time charter, which are for a certain period and we're going to earn commissions whilst the vessel is on those time charters, or sale and purchase transactions where it could be a second-hand vessel that's yet to deliver, or a new build, which we get stage payments over many years. But we've seen that since 2022, the forward order book has strengthened significantly, up 46% from where it was at that point. At the end of September, we had $26.7 million of revenue, which is going to come through in the remaining 5 months. And you can see the amounts going into HY27 and beyond are amongst the highest they've been. So we've really focused on growing that forward order book and the revenues looking forward. And you can see on the right there how that breaks down. Broadly, the breakdown of the forward order book is 50-50 between chartering, time charters, etc., and sale and purchase, whether it be new builds or second-hand deliveries. I'll now hand back to James to give us a strategy update.
Thank you, Grant. Okay, so for us, we put some things in place, as I mentioned earlier, back in May last year, and strategic framework. So basically, diversification, the most important thing was 5 years ago when I came into the CEO role, was to diversify the business and mainly concentrating on the shipbroking business and businesses that we diversified to complement those businesses. That we've done. And that's proving very clearly. For example, I can tell you that tanker rates were down some 25% in the last 6 months. Dry cargo rates are down some 17% in the last 6 months, but our revenue fell by 16%. So that shows you that by having a diversified model, that we're seeing our other departments compensate for those downward trends. So obviously for us, it's about also obviously globalizing the business and moving into new jurisdictions, which we've done. We've ticked that box already in Cape Town. And obviously, next thing we need to do is to move on the consolidation, target complementary business. That we have been doing. We've ruled out many businesses that did not complement the business and did not work for certain aspects. But the fact is we're maintaining the discipline, and we've also proven the fact that the acquisitions we have made in the last 2 or 3 years have complemented the business very and highly improved on the margin of the business. Operational excellence, that's something that Grant's been very much on top of. First, the focus on data and technology. A larger company with some 45 years of data going back is obviously imperative for the markets and seeing where the trends are for our clients. We continue to invest in compliance. That's becoming an important factor for our business. Shipbroking is not necessarily regulated, but it's moving more and more towards that case, and compliance is a large part of our business, and our clients are expecting it. And it's also potentially helping us with as far as acquiring smaller business, because the cost of those smaller business having compliance, etc., and is needed so much that makes it easier for us. And obviously, we want to drive efficiency and reward performance. Now, we also mentioned in May that we intend to move the business to a £200 million group revenue by FY30. Got to mention the fact shipbroking alone was making $65 million of revenue some 10 years ago. So we've already come a long way. We're also setting ourselves some strong targets. The risk advisory business, we're saying we've mentioned the fact that we want to be at £30 million by FY30, and we're very confident on that as we grow in that business. Underlying operating profit margin by 15% by FY30, and a net debt maintained below 1.5 EBITDA. Now, also we set some targets about 10 new hires. We're well on track for that, and had some very key staff within the business. So you can see from that progress report at the bottom, we've moved on very clearly on that strategy there. We mentioned about the fact we want to move into one new jurisdiction. We've done that in Cape Town. That business we knew very, very well, And I can tell you now that the reason why they want to join us was because they felt they were too small in what's becoming a business that is, is consolidating. So that made it very easy for us. So we've obviously done that already. The globalization of the globalized tank operations, this is more about efficiency and making sure the various different offices work together. And we will look to obviously see how we can obviously improve the margin there with looking elsewhere on the claims side of the business. So you can see we're moving across those arrows there. As regarding as I said, we've completed the one transaction. So as far as that, we're definitely on track for our strategic framework. Now, the outlook and summary. Okay. Chartering markets, as I mentioned to you before, the fact that the tanker rates was hugely down the first 6 months of the year. I mentioned some 25%, and the dry cargo was down 17%. You can see from our BRAEMAR index there. But the good news I can tell you is in the last 2 months, the markets have massively returned. Although there was uncertainty in the tariffs and as it was going on between the US and China, that seems to have settled down. We've seen some recent issues with some major companies being sanctioned again. This is creating the rates to move up. And I can also say I can tell you now that some of the dark fleet and grey fleet is moving out of the market or moving into a storage situation. So the rates are moving massively, and we're seeing more longer haul business. The dry cargo market has picked up as well in the last couple of months, and so we're seeing strength there. And we are definitely gaining our dry cargo presence in Australia, because we've seen a strong harvest in the year as well. Okay. Looking further ahead on demand, global GDP is on target. I think you can see that on the graph. You're well aware on that. China industrial growth. We've mentioned before in the past, we were expecting probably a bit more of China to come out after COVID, but that didn't necessarily happen. We saw major housing crisis, etc. in China. That's starting to turn again, and we're seeing that in the markets which we are involved in. And the oil demand index, well, that's obviously, since Russia's had more squeeze on the sanctions, as I said to you, that's increasing the OPEC outflow, which is creating more longer haul, especially US exports as well. So that's all in the good surplus for shipbroking.
Thanks, James. I'll just talk a little bit more about our risk advisory or securities business. So you can see quite clearly here the success we've had growing this business. It comprised 20% of revenues for the first 6 months of the year, up from 16% for the full year last year. And you can see quite clearly on the chart here, this particular revenue stream up 254% since 2022. And we've got plans to continue to grow that. So we said, as I said earlier, our UK organised trading facility, which is a specific venue that you need to trade certain securities products on, went live in May. Our UK clients are using that, and we can trade more products. We're expanding that offering by establishing a European OTF, and that progress, it's a very time-consuming process. Our UK OTF took over 18 months to obtain. Our Spanish OTF, is where we're putting it in Europe, is progressing well. We expect to have that in the first half of calendar year 2026. And we're also establishing a presence within the Dubai International Finance Centre. We have a freight desk in Dubai, but we're going to expand our securities offering there as well, again, to service our clients and their requirements going forward.
Thank you, Grant. Okay, so summary and outlook. I think as you hear from the presentation today, that we've explained where the first half was, and we can feel that the resilience of the business and diversification stories pulled us through what we can only say was a weak freight market and chartering market. So it shows the business is very robust, and we're building that business out to help that factor, so to help accommodate those problems. Underlying operating profit margin down by slightly 9%, returns in that cash position in October. As Grant talked about, the UK OTF and the European OTF. And we're interim dividend at 2.5p. So on the outlook, board expectation in line with where we were for 26, that totally remains unchanged. To start the second half, we've seen the markets return. We're feeling a lot more bullish than we were a few months ago. The forward order book is helping as we further build the forward order book, and our futures departments are doing very well on the back of the volatility in the markets today. So that leads us down to what our framework we put in place back in May, and we feel we're very much on track to deliver what we said we'd deliver. The pressure is upon us to deliver that. I think hopefully you can see that some of the businesses we bought already are proving very well, and we've definitely ironed out a few things that didn't work, but we are focusing on ones that can work and complement the business. And the market fundamentals remain strong. So we're feeling good about the next 6 months. Thank you. Thanks.
That's great, James Grant. Thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. James Grant, if I may now hand back to you and kindly ask you to read out the questions where appropriate to do so, and I'll pick up from you both at the end. Thank you.
Thank you very much. I'll read the questions here that come through on the iPad. Question is, what is the ideal long-term balance between chartering, investment advisory and risk advisory to smooth the earnings cycles? I would say, I'll take that first. I don't think there is an ideal balance. I think that by the virtue of the fact that we are diversified, that does give us the balance. So if you look back on that slide a couple of presentations ago, you would have seen that we had a very strong performance from tankers and a weaker performance in dry cargo. So overall chartering was flat, and we grew in investment advisory and risk advisory. And you've seen here weaker performance in chartering, but we've seen an improvement in risk advisory. So I don't think there is an ideal balance per se that we want X% of this and X% of that. But I think it's important to continue to grow all of those revenue streams with hiring individuals or teams or completing M&A acquisitions which are complementary to build the scale within the business. And so you just continue to drive the growth. I don't think it's right necessarily that we have a specific percentage target for each sort of division. If you want to add anything.
No, I just slightly add to that. How I see it is that because the business is more simplified in the last 5 years and we understand the sectors that we're in fully, of course, the most important thing is to build the breadth out of the business, but making sure that the complementary of the business works. The fact is, the desks work in harmony. If the spot market is rising, the futures market is busy. If the futures market is busy and the spot market is busy, the S&P transactions, because owners will be buying ships on the back of the present spot market. On the basis that our desks are talking to each other, there's a good reason why we're ahead of the curve compared to our competition. And we're for sure seeing the rewards on that as the markets tick up.
Thank you. Next question. Do you consider the current sentiment valuation to be in a trough with a decent rebound ahead as markets normalise? I assume we're talking about the share price here. Look, you can look at any of the analysts that are covering the stock, and the target price that most of them have is certainly above where we're trading at the moment. So they clearly believe that there's upside. There's obviously the challenges that the UK market, and particularly small cap, faces at the moment with the significant redemptions which are weighing not just on BRAEMAR but on a number of many stocks in the small and mid cap sector. So I think that's certainly having an impact, and I would like to think as we start to see fund flows come back into not just the FTSE 100 but start to trickling down to the mid and small cap, that we'll see some improvement as more funds come in.
And we're proving the fact that we put a buyback out, which we successfully completed back in September. So we personally believe that the shares are undervalued. But at the same time, we will build a business out to grow that, and we have confidence that we can move that share price in the right direction.
A question here about whether we consider the company could be a takeover target. We've got a view on that. We're just focusing on delivering what we are. I think many UK listed businesses are looking cheap at the moment, so I wouldn't really want to.
No, I just think that the shipbroking space is I've been in this business some 40 years, so I've seen weak markets and I've seen bull markets, and this market definitely feels different to where it was during back in 2008 before the crash. It feels there's a lot more longevity for many reasons. I mentioned before the fact that we're seeing some 25% cut in shipbuilding capacity. So leading back to the question, yeah, I mean, look, that's always a potential possibility someone comes forward, but the fact is we feel we're undervalued, and our job is to build ourselves out, and we feel there's a lot of things that we can get into that still complement the business, and parts of the world we can reach into to create more business.
Question here around cost. How much of the 30% rise in central costs is one-off, and should we expect margin improvement in H2? There is an element of one-off cost. If you look at the RNS, you'll see how we split it down. It's up 30%. There's a couple of elements in now. First of all, there was a one-off restructuring cost as we focused on efficiencies, and that was staff related. That was £500,000, which was a one-off in the first half. I mentioned that we had some additional property costs in there in respect to the space that it was let when we were in the process of re-letting it, because it's vacant at the moment. I'm hoping that won't be in there for the full second half, and should be lower. But if you think about the margin improvement, this business is very operationally geared, and we're expecting the revenue to improve in the second half. So if you look at first half versus second half, you would naturally see an improvement in operating margin. What is the outlook for tanker and dry bulk charter rates? Would you expect them to fall back now that China-US trade tensions have eased? Remember that a bit more, but we've certainly talked about the chart on that, haven't we? We haven't seen
I think that's not necessary. I think it's a situation, the impact on the various sanctions recently, and obviously that. So what I'm trying to say here is the fact the sanctions in Russia have increased and made it more difficult. So whereas a lot of that oil was going into India to be blended and moved out again, that's not happening so much. We're seeing less of those dark fleet ships that were doing that business now falling into a different scenario, which means that, as I mentioned earlier, they're going into storage, which potentially leads to believe there could be a massive contango in the forward markets. So it brings in then more modern ships of the unsanctioned ships that are doing longer haul voyages out of the US, etc. So we're just seeing more ton miles, and we're just seeing the market massively rebound in the last 2 or 3 months. So the moment we don't see that going away, I think if you also want to look at some of the equities in tanker stocks across the globe, you'll see they've also massively rallied in the last 2 or 3 months, and that's exactly for the reason why I just mentioned.
Question here: what is the reason for the second half bullishness? I think we've talked about that when we've seen where the rates are. I think it's also worth mentioning, if you look at the business has an element of seasonality in it, where the second half you do generally see an improvement in revenues in the second half, driven by colder winters, etc. Last year you didn't see that. It was very much a one-off. If you look back historically, you'll see second half performance will beat first half performance, and we expect to see a return to normality in the second year, and that's sort of added a bit more around what we've seen on rates, etc. What is the trend in fixture volumes? Is the increase in chartering rates enough to more than offset any decline in fixture volumes? We've definitely, as I said at the start, there are longer voyages, so there's fewer ships available to fix, and of course there's been approximately, the best estimate we've got is that there's sort of 1,400 vessels that are now in dark fleet, so they're out of the fixture pool, if you like. So yeah, there has been a downward trend in fixtures, but we believe that what we're seeing on rates will offset that and mitigate that. Given the rapid rise in the LNG fleet, is that a vertical you should have a much larger exposure to? If so, how can you expand this?
That's an interesting one, okay, because we were discussing that this morning. The LNG fleet has massively risen, and we are involved in LNG new buildings, and we have an LNG desk. The fact is, the market is in its worst doldrums at the moment, and we feel we slightly we're able to avoid some big highs we might have made a couple of years ago when the market's crashed, because a lot of the big transactions or the big deals that were supposed to happen, like Mozambique coming on stream this year, has been delayed by another 2 or 3 years. So we're seeing the rates very weak. We're seeing new building prices falling down LNG because we're realising the rates aren't there. So for us, this gives us an opportunity to build the next 2 or 3 years for a market which we feel will return then. So the moment we feel an opportunity to come open to us, but at the same time, for those having a large LNG desk, we'll be feeling the cost of that at the moment.
What's caused the new build sale and purchase market to improve recently, given the delay to the IMO net zero framework? Is it greater confidence in future rates and demand, or availability of shipyard capacity?
I'd say touch base on that earlier as well. I mentioned the fact that the shipbuilding capacity was cut by some 20-25% since the 2008 crash. There's obviously the big talk the last 2 or 3 years about alternative fuels, whether that be LNG, fuel chips, or ammonia, or methanol, etc. We're seeing less on the ordering of those ships, but we're seeing more increase in orders on conventional ships. So at the moment, we're seeing ships now. We've been working some deals where we thought we could get delivery by second half 28. It's now moving into 29. The market's obviously strong. There's an aging fleet. IMO is sometimes slower to react on certain things. We worry as a broker, looking at certain aspects of the business, how many ships are in the dark fleet and grey fleet, as we would call it, flying probably under flags of non-shipping national. So we worry about certain things that potentially these ships aren't being maintained correctly. So look, I think at the moment there's just a demand to build ships, and the yards are definitely holding that. But also on top of that, it's slightly different from where it was in 2008. It's so much more diversified, as in what ships are being ordered, because most markets are in a good shape. So that's what's putting pressure on the prices.
Thanks, James. Just a question here. The analysts over the last 5 years have been generally positive with a buy recommendation, but the shares have generally traded 30-40% below. Are the analysts well informed? Look, I think
Frustrating.
That's frustrating for us. There's no doubt about that as well. And I think if you follow the story, you'll see that we recently, about a year ago now, we changed corporate broker. We've changed our financial advisor. We are making steps to articulate our equity story perhaps clearer than it has been historically. And so we are trying to address that. It's obviously a frustration internally, as well as it must be for our existing shareholders. Yeah.
Perfect. That's great, James, Grant. Thank you for addressing all those questions for investors today. And of course, the company can review all questions submitted today, and we'll publish those responses on the Investor Meet Company platform. But James, before I redirect investors to provide you with their feedback, which is particularly important to the company, could I please ask you for a few closing comments?
Yeah, first of all, I'd say thank you for taking time to listen to our presentation today for the first half of 26 results. I'd like to emphasise again that we feel it's going to be a year 2 halves for sure. I think the first half has been a bit more challenging, but I'd like to see from the results here, you can hear the fact that the business has been diverse to sort of take some of those punches on low chartering rates by building the model out. And we're feeling confident for the second half because the rates are returning, and you can see our forward order book is increasing, dropping into this year. And, we're excited. We feel we're in a good place. There is always some challenges in a broking business, but the most important thing is we've got a good young team across the globe in some 19 offices around the globe in 13 different countries. And it feels at the moment that everyone is exceptionally busy, and that's the most important. And on top of that, I think we're seeing the dollar sterling going a bit more in our favour, which is always a bit more helpful compared to the first half. So, listen, most of all, thank you. Thank you so much for taking time to listen to us. And by the way, myself and Grant are always there to answer any email questions if you have further questions to ask afterwards. Okay, but thank you so much.
Thank you.
Fantastic, James, Grant. Thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete and I'm sure will be greatly valued by the company. On behalf of the management team of BRAEMAR PLC, we'd like to thank you for attending today's presentation and good afternoon to you all.
Thank you. Bye-bye.
Thank you very much.